Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you today. We're going to talk a lot about market volatility, what's going on currently in the economy, and really how you should be invested. If you have any investment questions, please send those to Brian Rezny at ReznyWealth.com. We want to make sure you get the right answer on all of your investment questions. And also visit our website, ReznyWealth.com. We have some upcoming workshops through the rest of the year that you can sign up. Perfect for retirees and pre-retiree couples who are concerned about the advice they're receiving, are concerned about the direction of their portfolio, or you're concerned about the lack of performance in your portfolio. Go to ReznyWealth.com, check out our upcoming workshops, and make sure you attend. You know, we've had a lot of volatility as of late, and one of the questions I'm receiving a lot is about market volatility. In times of increased volatility, it's important to revisit these important lessons and the underpinnings of a successful investment strategy. Remember, markets are always going to do this. And I don't care if you're a conservative investor in the bond market, bonds go up and down. I don't care if you invest in real estate, gold, or anything in the middle. All investments have short-term volatility. It's how you cope with that volatility that's going to ultimately determine if you're going to be a successful investor. I can tell you, all this volatility we've seen of late, the questions that come in is, are people selling? I can tell you, my clients are not calling our firm concerned because they know we run the portfolio properly and we have risk management in play. That doesn't mean we're not going to have short terms of volatility. What you want to control major risk, which is from the next major recession. So let's revisit the last recession, which was 2008. It was the collapse of a lot of the banks and the freezing of credit in the United States and ultimately almost around the world. We don't have that apparent today. The banks are in healthy shape. The economy is growing. Our recession indicators are not pointing to recession, and we look at these on a daily basis. So remember, we're in an uptrend in the economy. Unemployment's good. GDP, gross domestic product, is growing. Corporate earnings are almost at a record high. Corporate balance sheets are excellent, and consumers are repairing their balance sheet, and housing is doing quite well. So ultimately, no signs of recession, meaning you should be invested properly and accept short-term volatility. If you can't accept any short-term volatility and you're worried about what happens today, next week, or next month, you'll never be a successful investor. I always try to explain to every investor, if you're not a 3 to 5 year minimum investor, meaning you're not going to liquidate all of your portfolio in the next 3 to 5 years, you're a long-term investor. The only way you have a chance to make an above average return, more than zero, is if you're a longer-term investor and you invest properly, or you get professional help from a real money management firm, a fee-only fiduciary. Let's talk about rule number one. Markets are not efficient, whether it's the bond market, real estate, or the stock market. We may not like the market short-term reactions, but markets are not efficient on the short term. Meaning, just because the markets drop 5% in a day, has anything fundamentally changed in that day? No. One of the issues that affect every investor is news. Cable TV is rampant, 24/7 news, and there's not a lot of new news, so the same negative news is often repeated multiple times throughout the day and the week. Investors get scared. The other problem is you, the investor, check your brokerage statement too often. Remember, you're not a 1 day or 1 month or 1 year investor. You're a 3 to 5 year minimum investor. If you're 70 years old and you're not going to spend all your money in the next 3 to 5 years, which I hope you're not, you're a long-term investor. So regardless of age, you're going to have to accept short-term volatility, not big downside volatility, but short-term gains and losses in order to have a chance to prosper. Rule number two, market timing is speculation. Trying to go every tick of the market, every up and down, get in, get out. I can tell you I've never seen anybody successful doing that. If you're a rampant speculator, you're probably not making any money with your money. We had a lot of volatility as of late. A lot of volume, meaning downside selling. Who was doing all the selling? I can tell you from friends that I have in the industry on trade desks and with some of these bigger firms that it tends to be the do-it-yourself investor. These investors often do way worse even than working with a broker because they don't run an investment strategy. Do-it-yourself investors have been repeatedly bad investors time in, time out. They think it's easy. Wall Street shows you, get your phone up. Get an app. You can trade at your son's baseball game. Baloney. All that is so those firms can make more trade revenue. It's going to make you less money. So if you're a do-it-yourself investor, I can pretty much guarantee you probably don't have a written investment strategy you follow. You're probably shooting from the hip, and you're probably one of those investors that's sold at the bottom, and you'll buy again when it's at the top. Run an investment strategy, or you'll have no chance of success. Rule number 3, diversification is the only antidote for uncertainty. Although diversification is not going to ensure a profit or guarantee a loss or a smaller loss or decline, you need to diversify, but not over diversification. That big giant pie that Wall Street puts on brokerage statements that has 50, 75 investments, that's over diversification. Remember, you want to be properly diversified, but don't be over diversified. And certainly never put your eggs all in one basket. Rule number 4, there is no free lunch. Risk and return are related. Remember that. Higher expected returns only come from taking on a little more risk. That's the bottom line. If you cannot accept 2 to 3 or 5% movements in your overall valuation of your portfolio month by month or quarter by quarter, or 10% swings possibly, you'll never have a chance to make more than CD rates of return. Put your money in the bank. But if you're level-headed, you're not emotional, you don't check your investment values 5 times a day, you can be a longer-term investor for the next 3 to 5 years and have a better chance of making a real return on your money instead of sticking it under the mattress. Rule number 5, save yourself from yourself. Legendary Benjamin Graham investor tells us, the investor's chief problem and even his worst enemy is likely himself. Investors get nervous when things go down. They're joyful when they go up. Things go up and down, and long term, people have made great returns and great money. You, the investor, are often your worst enemy. I can tell you that I've been managing money for 28 years. My staff and I run very strict principles on how we manage portfolios. Most individual investors that work with brokerage houses or annuity salespeople have no strategy at all. Individuals that are doing it themselves often have no strategy either, and they're shooting from the hip. The only way you can be successful is run a disciplined strategy, control your emotions, which will lead to bad behavior. Rule number 6, remember your time horizon. You need 3 to 5 years income in a more conservative portfolio. So what I want to say is this, whether you're 30, whether you're 75, you're a long-term investor. As you get older and into retirement, if you need income from your portfolio, have 3 to 5 years on the more conservative side in the portfolio. Things that are less volatile, less chance to fluctuate to the downside, more than 5%. The rest of your money should be set up for growth and income. So if you're going to be a long-term investor, 3 to 5 years, you're not going to spend all your money. Do the right thing. Remember your time horizon. Don't be nervous. Be a smart investor. If you need help managing your money properly, which includes risk management, hire a real investment firm, a money management firm, a fee-only fiduciary firm. You can always call my firm for a consultation and a portfolio review. We do deal with larger portfolios. So if you're somebody with a larger portfolio, call my office. Schedule a review, whether it's in our Naples, Fort Myers, Boca Raton, or Coral Gables office. We would like to talk to you. If you're tired of Wall Street's bad advice, call our firm. Schedule a consultation. There's a big difference. Tom in Fort Myers, Florida. What do you think about putting all of my retirement investments in the S&P 500 and taking 5%? Tom, I think that's a bad decision. The S&P 500 does represent large cap stocks primarily in the U.S. As an investor, you need to be more diversified than that. Now, the S&P longer term has done well, but remember, the last two recessions, the S&P dropped over 50% in 2000, and the S&P 500 dropped another 50% plus in 2008. If you just put it in the S&P 500 and you take 5% out, and we have another market correction or recession, and you lose half of your money, the money that you need to take out is going to have to double, and you're going to melt away your portfolio. You need to be better diversified. By the way, other investment sectors or asset classes have actually done much better than the S&P. So what I would say to you is this. You need between 6 and 8 different investments in a portfolio. I prefer ETFs or exchange-traded funds to be properly diversified. Look at different sectors, different market caps, and different areas of the asset class spectrum to invest in. Don't forget small cap and mid cap in the U.S. because they've actually outperformed the S&P 500 large cap. Don't forget about areas like emerging markets, different kinds of bonds, potentially currency or gold. It doesn't mean they're going to use all those at the same time, but it means you need to look at other asset categories that have outperformed the S&P. I'll give you a little tip. The S&P 500 is capitalization weighted, meaning the biggest companies represent the majority of the S&P returns. Did you know equal weight, equally spread out 500 S&P stocks actually outperform the S&P by a country mile? Maybe you want to look at that in addition. I can tell you at my firm, we look at alpha and beta strategies. Important things when you're managing money. You can always call my firm for a consultation. Mike from Cape Coral, Florida. What funds do you recommend for the best return in the short term? Mike, short term to me is less than 3 years. If you're a 3-year investor or less, you need to be very conservative. In today's market, you're probably going to make 1 to 3% if you're lucky to make in a more conservative short-term bond fund. That's probably it. You still have some market risk, though, even with bonds. Remember that. There are no great investments short-term. So if you need this money short-term, and short-term to me, again, is less than 3 years, let's say you're going to purchase a house and you need a $50,000 deposit for that house in the next 6 months, stick it in the bank. You're not going to make much, but you're not going to lose anything. Any money that needs to be there for sure in less than 3 years, don't take much risk. You're not going to make any money on it or much. You're better off to be way more conservative than too aggressive. Too often what I find investors is they look for the number one investment today, or they read Money Magazine, the 10 stocks to buy now. The problem is, when do you sell those stocks? Too many investors, again, will buy things they hear about because they sound good, but ultimately they don't know when to sell. So when those investments go south, you don't sell at a smaller loss. You end up often holding these things down as they go down 50, 60, 70, 80% because you don't have a sell criteria. Every investment strategy, you need to know when to sell. Don't worry about trying to time the market on every short-term volatility. Make sure you're looking at the long term and look at recessions, review them, and know when ultimately to reduce risk in your portfolio, which is the next recession, which could ultimately be closer than you think. I'm going to take a short break. Visit my website. Make sure you check out our upcoming workshops about investing for retirees and pre-retires. If you're concerned about your portfolio, if you're concerned about the advice receiving, call my firm for a consultation. I'll be right back. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back. If you have questions about your portfolio and investment in your portfolio, maybe you're wondering if the firm you entrust your money to is a fee-only fiduciary money manager, send us an email question to brianresny@reznywealth.com or visit my website, and you can go to the question box there and send us a question that way. We want to make sure you get the right answer so you can make better decisions around your retirement. Our goal with not only my TV and radio show is to educate you and empower you so you can make better decisions and live a more successful retirement. Sam from Naples, Florida. What funds or funds do you recommend for a first-time investor with only $15,000 to invest? Sam, that is an excellent question, and I'm glad you're asking. First off, I would not use mutual funds. Mutual funds are usually sold through brokerage firms and they have much higher expenses. Mutual funds in general often underperform their base index. In fact, there's been a lot of studies about mutual funds underperforming their indexes, whether it's 1, 3, 5, or even 10 years. Often 80 to 90% of mutual funds underperform, meaning they can't even keep up with the base index. So if you can't keep up with the base index, why invest in a mutual fund? You shouldn't. Look at ETFs, exchange-traded funds. What I would recommend you do first off, if you're a younger person and you are saving for retirement, meaning you don't need this money for a long time, look at setting up a Roth IRA. You can fund that Roth IRA each and every year if you are within the qualification zone on the IRS tables. Once you do that, what I would have you look at is look at ETFs. Here's a couple I'll give you to research yourself. Look at the iShares IJR, it's small cap. Fair disclosure, we do own that in managed accounts at Rezny Wealth Management. Small cap US 600 stocks. Great place for an investor who's looking to grow. Another one you might want to look at is the Guggenheim Equal Weight S&P 500, which I talked about Equal Weight S&P earlier in the show. That's RSP. Look at both of those. Maybe you do a 50-50 mix as long as this is not money you need for at least 3 to 5 years and you want to grow it. Those are two great areas that I would definitely look at. And again, fair disclosure, we own those in managed accounts at Rezny Wealth Management. But Sam, make sure you take a look at setting up a Roth IRA account. You can fund that every single year and think about how much money you'd have. When you put money into a Roth, it goes in after tax, but it grows tax-free and it comes out tax-free. Two powerful tools, ETFs, exchange-traded funds, versus a mutual fund, and look at setting up a Roth IRA account for your retirement today. Jason in Fort Myers, Florida. Where can I get the best, most unbiased financial advice? Jason, that's an easy question. If you want real money management, meaning you want a firm that actually manages your money and legally works for you, you need to hire yourself a fee-only fiduciary money manager. My firm is a fiduciary. We are a fee-only firm. Just to give you a heads up, no Wall Street firm is fee-only. No Wall Street firm is a full fiduciary all the time. So just understand it. So if you go to any Wall Street firm, any bank, they're not fiduciaries. They're not fee-only firms. Anybody who sells annuity products is a salesperson in addition. They're not fiduciaries. These people do not have to work in your legal best interest. So what you want to find out is, are you a fee-only fiduciary? A lot of these firms will tell you they're fee-based. Fee-based is still sales, bottom line. All the banks, brokerage firms, and insurance companies bamboozle people into thinking fee-based is fee-only. It's not. Go to my website, reznywealth.com. Download for free our groundbreaking report, Your #1 Investment Risk, Fiduciary versus Suitability. It comes with a questionnaire. So as you go and interview firms and you find some fee-only firms to interview, bring the questionnaire with you. There's 12 simple questions that they need to answer in front of you, and they have to sign off as a fee-only fiduciary. This way you know you're going to get unbiased advice. If you go to Wall Street, it's going to be sales, it's going to be suitability. They don't have to legally work in your best interest. They can work against you. The guy hawking annuities, I call them the annuity charlatans of the world, also don't work for you. Protect yourself. The way to do it, find a fee-only fiduciary firm. Dina from Cape Coral, Florida. What do you think about the Allianz Accumulator variable annuity and variable annuities in general with income riders? My advisor is suggesting I put my 401k rollover in one. Dina, don't do it. First off, your 401k plan is already tax deferred. Put it in a regular IRA account. The person that you're clearly working with, your advisor, is really not an advisor at all. Back in the day, they used to call these people stockbrokers or annuity salespeople. Now these guys all take the fancy title of advisor, which is worthless. The person sells annuities. I would not buy a variable annuity ever, and let me tell you why. The typical variable annuity, and I can tell you Allianz Accumulator, I've looked at that one in addition, but the typical variable annuity that I review and my firm reviews all the time have annual expenses. Get this, annual expenses often higher every year of 4.5%. If you get a variable annuity, between the annuity wrapper, the sub-accounts that you invest in, and that income rider, you could easily be approaching 4.5% a year against your earnings. Let me give you an example. If your variable annuity makes 6% and your expenses are 4.5%, you only get to keep 1.5%. If you take that money, put that in a managed account, and let's say you just buy low-cost ETFs, that the average ETF only costs you 0.5% a year. They're actually much less than that, but let's just use 0.5% for easy math. You just cut out 4% a year of expenses. So if you had $1 million and you saved 4% every year on your expenses, that's $40,000 a year, Dina, in your retirement account. That's huge. In 10 years, you've saved $400,000 in extra expenses by not being sold an annuity. Annuities are dangerous to your wealth. The expenses are sky high. There's no benefit to buying an annuity, but these annuity salespeople will twist it different ways and convince you there is. What I would suggest you do, go to my website, reznywealth.com. Download for free. I wrote a special report. It explains annuities, how expensive they are, how these annuity people that sell them often sell on lies and deceptions. It's called Why Annuities Are Dangerous to Your Wealth and Retirement. It's free and it's on my website at reznywealth.com. Read it once, read it twice, read it 3 times, and after that, if you decide to buy that annuity or any annuity, I feel sorry for you and your future retirement. Bill from Fort Lauderdale, Florida. Can you recommend any ETFs, and do you like them more than mutual funds? Bill, I definitely like ETFs way more than mutual funds. I would prefer investors utilize an ETF, which stands for Exchange Traded Funds. And the reason for that is, again, I talked about this earlier. Most mutual funds underperform their base index or benchmark by a country mile. There's no reason to buy one. The expenses are high. Morningstar says that the average mutual fund average annual expense ratio is 1.65% a year. The average quality ETF that I would utilize in a client portfolio usually runs about 15 basis points or 0.15%. Very little. So 165 or 0.15. You save a 1.5% a year by utilizing ETFs. I talked about a few earlier. There's over 1,000 ETFs today. I would primarily be looking at the small cap marketplace if you're trying to grow, mid cap and large cap in the U.S. Look at equal weight, look at share buyback ETFs, things of that nature. If you'd like, you can always call my firm for a consultation. We can construct and manage a quality portfolio for your retirement. Dan from Naples, Florida. My wife and I attended a dinner seminar and the presenter talked about hybrid annuities. He discussed 10% bonuses and 8% returns. What are your thoughts? Dan, you better run fast. I can tell you that the majority of people that go to these free dinner seminars are being suckered into buying expensive annuities that ultimately rob the return. First off, there is no 10% free money with annuities. If the person's telling you that, they're misrepresenting the annuity and they're lying to you blatantly. If you take the bonus on a hybrid annuity, there's an annual cost for that bonus, often approaching 1+% a year. So 10% free money, but there's a yearly cost to get it. How is that free? 8% returns on annuities? That's, again, more lies and fabricated stories by the annuity salesperson. There's no annuity that pays 8% on your actual money that you can take all of it out tomorrow. It's called the hypothetical, I call it the fake pot of money on the other side. Remember, there's your real money and there's the fake pot of money with hybrid annuities. That 8% return go on to the fake pot of money. The only way you can get that 8% is if you then annuitize or take an income out of that fake pot of money at substandard rates. I would read the fine print. I could tell you, I look at literally hundreds of hybrid annuities from all these different companies every single year. Often people get suckered into buying these things, and then they call my firm 3 or 4 years later when they finally figure out they were duped into an expensive annuity, and now they want to know how to get out. Do the research before you're sold one. There's no free money with annuities. They're expensive, and there's no 8% returns, and if you believe that, it's going to hurt your retirement. Lynn from Bonita Springs, Florida. We are invested in asset allocation program through a Wall Street firm. It really hasn't done much in 5 years, but seems to still go down when the market goes down. Do you believe in asset allocation? Lynn, I'm not a big believer in asset allocation like Wall Street firms push. What they basically do is take your money, they throw it in this big gigantic pie and they chop it up in little pieces. They own everything all the time. And there's times you do not want to own everything all the time. As an example, the big favorite with most Wall Street firms is always own certain kinds of bonds in your portfolio, gold and commodities. Well, a lot of these have done very poorly as of late, and it's dragging down the good stuff in your portfolio. We believe in relative strength investing, being in relatively stronger areas, not only economic-wise, but also on a relative performance basis. Asset allocation that's pushed by Wall Street firms doesn't work. You still see the downside, you don't see the upside, so at the end of the day, you haven't made a lot of money. And that's the problem with general asset allocation. I don't think it works. I think you're over probably diversified, and weak assets pull down strong assets, and then the return you have is lousy like you explained, but you're still taking downside risk when the markets go down. If that sounds like you, if you're concerned about your portfolio, is your portfolio performing the way it should to meet your goals? Are you truly happy with the advice you're receiving? Schedule a review and a consultation. Get a second opinion with my firm. We want to help you. We want to make sure you're doing the right things with your investment portfolio. Get educated, get empowered. Visit ReznyWealth.com, download any of our free reports, or check out our upcoming workshops. Remember, it's up to you to take control of your financial future. Do what's right for your retirement, make good decisions, hire only a real fiduciary. I'll see you next week.